Welcome to our channel, where we dive deep into the world of finance and investing. Today, we are going to discuss a topic that has been on the minds of many investors: the rise of robo-advisors. Over the past few years, robo-advisors have been gaining popularity, but are they replacing human money managers? We will explore this question and provide the latest data to help you make an informed decision. The world of investing is constantly changing, and robo-advisors have disrupted the traditional model of wealth management. With technology advancing at a rapid pace, investors are left wondering whether robo-advisors are here to stay or just a passing trend. In this video, we will take a closer look at the rise of robo-advisors and how they are transforming the investment industry. Firstly, let's define what robo-advisors are. Robo-advisors are digital platforms that use algorithms and technology to provide automated investment advice and portfolio management. These platforms have been gaining popularity over the past few years, with the global robo-advisory market expected to grow from $19.5 billion in 2020 to $27.8 billion by 2025, according to a report by Markets and Markets. One of the main benefits of robo-advisors is their low cost. Robo-advisors charge a fraction of the fees that traditional human money managers charge, making them more accessible to retail investors. Additionally, robo-advisors are known for their simplicity and convenience. Investors can open an account, complete a risk assessment questionnaire, and have their portfolio built and managed for them automatically. However, there are also some downsides to robo-advisors. One of the biggest concerns is the lack of human interaction. Traditional money managers provide a personal touch and can tailor their advice to individual needs, something that robo-advisors cannot do. Moreover, robo-advisors are not suitable for all investors, especially those with complex financial situations. Now, let's look at some statistics. According to a study by J.D. Power, only 15% of investors use robo-advisors exclusively, while 45% use a combination of both robo-advisors and human advisors. This indicates that investors still value the importance of human interaction when it comes to their investments. Additionally, a survey conducted by Deloitte found that 64% of investors would like to have access to a human advisor, even if they use a robo-advisor. This shows that while robo-advisors are becoming more popular, they are not replacing human money managers entirely. Moreover, the COVID-19 pandemic has accelerated the adoption of robo-advisors, as people have become more comfortable with using digital platforms for financial transactions. In fact, a report by PwC found that the pandemic has led to a surge in demand for digital financial advice and that robo-advisors are well positioned to meet this demand. In conclusion, the rise of robo-advisors has disrupted the traditional model of wealth management, but they are not replacing human money managers entirely. While robo-advisors are gaining popularity due to their low cost and convenience, many investors still value the personal touch that human advisors provide. The COVID-19 pandemic has accelerated the adoption of robo-advisors, and they are well positioned to meet the growing demand for digital financial advice. As an investor, it is important to consider your own financial situation and preferences before deciding whether to use a robo-advisor, a human advisor, or a combination of both. We hope that this video has provided you with valuable insights and helped you make an informed decision. Check this video on screen to choose the right money manager for your financial future.